and welcome to Friends That Invest, the podcast that feels like a voice note from your favorite finance friend. You're joined today by your host, Sim Kaur. I am so excited to be here. I am wildly passionate about investing and personal finance. And today we are going to talk about what is going on with the Fed, with interest rates, and what it means for you and your money. Because if you are new here, you may not realize that when it comes to investing, share prices go up when interest rates go down. And when interest rates go up, share prices go down. And so you might be like, okay, Sim, that's not good. Why is this happening? Is this something that's going to occur? And what does this mean for my money? So let's go straight into it. First things first, the Fed, who are they? What do they mean? What are they trying to do to me? And how does this affect my money? The Fed is essentially like the bank of banks. So in New Zealand, we have the Reserve Bank. And in the States, they have the Federal Reserve. We're not really like that creative when it comes to naming them, but they are the bank for banks. And when normal banks like your local bank, your Wells Fargo, your American bank, your New Zealand bank, your NAB, when those banks come along and they go, hey Sim, I will offer you a mortgage, I will give you the cash for your mortgage, but I'm going to give you it at a mortgage rate of 4%. They only set that rate because of how much it costs them to have the debt. And so the Federal Reserve goes, hey, we will give you money at 3% and therefore you can sell it on at 4%. But if the Fed goes, we're going to set the rate at 5%, then the retail banks, the banks that you and I go to get a mortgage or to get a loan or to put our money into, they have to set their mortgage rates slightly higher so they can, make a little bit of profit. I mean, that's what the banks, you thought the banks were here to look after your money? No, they are here to make a profit off your money. And so that leads into the question, well, Sim, who is the Fed in the States? Like, what's going on here? And recently, the new Fed chair has been sworn into the US. This is kind of like when the Pope changes, but in the financial world, like the finance bros have a new Pope. His name is Kevin Warsh. He was replacing Jeremy Powell. And this was not something that people were surprised by because you can only be in the Fed chair for so long. And Jeremy, when he left, had some beef with Donald Trump just because Donald Trump was encouraging him to lower interest rates. And he was like, I don't, bow down to anyone. It's like when Henry VIII was saying to the Pope, you need to allow me to get a divorce. And he was like, that's not allowed in the Catholic Church. Now, I'm not saying Donald Trump has now gone off and started his own religion or a new Fed, but a new Fed chair has come in. Not a good thing, not a bad thing, just some change. It's like new management's coming. And what we know about Kevin Warsh is that it's kind of hard to say if he is someone that's going to increase interest rates, if he's going to decrease interest rates. Ideally, we want him to keep interest rates low, but there is a little bit of rumors on Wall Street that interest rates are going to rise. So let me read some information that I've come across. So according to the CME FedWatch tool, there is a 70% chance of the Fed raising the federal funds rate by the end of this year. The heaviest odds, more than 40%, are on the Fed doing 1/4 point rate hikes from the current target of 3.5 to 3.75%, and they see a 22% chance of 2 hikes. So essentially the Fed has 2 opportunities till the rest of the year to increase, decrease, or keep the rates the same. And a lot of people are saying, yeah, there's probably a chance they'll increase it at one point, but not that many people think that at every conversation that they have over the next 2 conversations that they're going to increase it again and again. So what does this mean for you? What is this going to do to markets? So an increase in rate hikes can be kind of broken down into different groups of people. So let's start off with homeowners. Those are kind of the easiest group to understand because if you are a homeowner and interest rates go up, then your mortgage interest rates are going to increase as well. Now, our American friends are very lucky because they get to lock in interest rates for 30 years. So if you're one of those lucky humans that locked in a 3% or a 2.5% interest rate on your mortgage, you are sticking that out. Whereas we're not so lucky in New Zealand and Australia, and I believe Canada as well. Our mortgage interest rates kind of go on a rolling period of 5 years, 3 years, 2 years, 1 year, or you can just have it at a floating rate. And so that means that maybe for a few years you might have a 4% interest rate. But the time that it then comes to revolving your interest rate, to rolling it over and getting a new rate, you might end up having it higher. Also, if you're an American and you're looking to buy your first home or to buy a piece of property or to take on debt, if interest rates increase, then now it's going to be a lot higher than like what it looked like 5 years ago, when, during the good old days when you had like 2.5% interest rates. Like, what a different time. We take a lot of things for granted in hindsight, but I guess that's what hindsight is. Now, the issue for homeowners is that if you have mortgage repayments increasing, suddenly you can't really afford that like holiday you wanted to take, or you might not go out to dinner as often because like it's expensive having a home, so you're going to stay at home. If you have investment property, for example, then you might increase the rent of the investment property, so your renters now have to pay more, and so they're also going to be in a much tighter position where if your rent has increased, like, are you really going to go out and like grab a drink with dinner? Are you even going to have dinner out, or is this going to be like potluck season with our friends again? And so the spending of houses starts to decrease. Homeowners and renters, basically human beings, are not going to spend as much money when interest rates go up. That then starts having a flow-on effect for businesses, because why would you go to the mall and like update your mascara when things are kind of expensive? We already have a cost of living crisis. I don't want to go and like spend more money on mascara. I'm going to keep using the same mascara that I've had for like 12 months, even though I'm pretty sure I heard someone say that you should be updating your mascara every 3 months. Blows my mind. That just does not seem reasonable. But, you know, as someone that was an optometrist, I probably should be updating it more often, but I don't. And that is just the honest truth. We're all honest here. So think now to the business owners. They aren't having people spend as much money. That's kind of annoying. It means that their sales are down. It means that their profit is down. And business owners have a double whammy because debt becomes more expensive. If debt is more expensive, then suddenly their costs increase, their revenue is decreasing, and so their profit margin shrinks from both sides. It's like being between a rock and a hard place. And so businesses start to shut down, or they're not making as much money. And that's both for private businesses and public businesses. Now, if a private business shuts down, that's really terrible for the private business owner and their family, but everyday people aren't usually shareholders in private businesses. So from an investor point of view, it's sad, but it's not going to affect our bottom line. However, a lot of investors, most of us that invest in public companies. And unfortunately, public companies have the same issue. They also have debt. They also have customers. And so if people are spending like less money at a makeup store or a clothing store, or even just like they're not updating their cars, or they're not getting like more insurance, then suddenly these insurance companies, these consumer good companies, these tech companies start to see a decrease in revenue. And for the debt that they have, the interest rate on their debt increases, so they are also between a rock and a hard place in the exact same way small businesses are. The difference, though, with public companies is now they have shareholders, people like you and me, that like own a share of Apple or own a share of Ultra. We go, this company's profit is decreasing month by month, year by year. I'm going to sell. And so a lot of retail investors or institutional investors will sell down their shares, and then the share price starts to tank. And that is the reason, that is the like very long-winded, but also somewhat simple way of explaining that when interest rates go up, share prices go down. And so when I see the news of interest rates have a 70% chance of going up, I'm mentally preparing for my share portfolio to start decreasing a little bit over the next wee while. I have personally seen a huge increase in my investment portfolio, especially from January till now at the time of recording at the end of May. And that is like nothing to do with like my personal skill. Like I have not found the next Nvidia or something ridiculous. I have just been investing consistently over a long period of time in broad market index funds and a couple of individual companies, but mainly index funds. And because the market has rallied so much, every day when I log in and I look into my investment portfolio, it has just been rising and rising and rising. And mentally, I am not looking at that money thinking this is all for me. I'm so like grateful. I'm very much aware that we're probably reaching a bit of a bubble or a peak. And let's just like, what is the saying? Let's not count all of our chickens. Let's not count all of our eggs until they hatch. That's the one. That's the one. And so from an economic point of view, when interest rates rise, we also start to see economic growth decrease. We start to see reduction in business expansion. Companies aren't going to spend as much on like trying out new things or being more innovative. It's not really the time to like be taking risks. And then on top of that, we sometimes see job losses or wage freezes, which is already kind of happening. So it is quite scary. Then you kind of look at all that and you go, Sim, like job losses, expensive mortgage, no spending, business shutting down. Like this sounds really sad. Is there any silver lining to interest rates rising? And the answer is yes. I mean, there's two things that you can kind of be a little bit happy about when interest rates rise. The first is interest rates rise to help mitigate inflation. So when inflation starts to go up a little bit too much and suddenly everything is getting more costly, an increase in interest rates kind of has a flow-on effect to help cool inflation down. And so that's why the Fed in the US says, do you know what? We're going to sort of like put a little bit of pressure on inflation, just start to like push it down. It's a little bit like whack-a-mole where you push down inflation. But to do that, you have to rise interest rates. And so it's this like delicate dance between, it's kind of like being a woman and you don't want to dress too attractive at work because you get the wrong attention, but you also seem to not go as far if you appear like you don't care about your appearance. And it's this like annoying middle ground that you have to walk. The Fed has the same issue, but the Fed is not a woman trying to get a promotion. The Fed is just trying to keep inflation at bay and also interest rates at bay. Maybe not my best example, but you're kind of understanding where I'm coming from. But as I was saying, there are some silver linings in this. And the first silver lining is that for savers, this is a really good thing. Do you remember when high yield savings accounts were like up to 4% returns or like 3.5% returns? That is so huge. That's like saying if you have $1,000, rather than putting it in the share market and like hopefully having a 7% return, you could have a guaranteed 4% return by putting it in a savings account where there is less risk and the return is guaranteed. With investing in shares, there is always risk and the return is not guaranteed and you can have a negative return. So when you're weighing things up and the interest rates go higher, then high yield savings accounts are such a great option because their interest rate increases as well. So right now you might see only like a 2% interest rate or a 2.5% interest rate on savings accounts. But if interest rates increase, then that might also increase. You might see 3, 4, 5%. And so there are some positives in that regard. So then you're probably listening to this and going, okay, Sim, it seems like there is a chance that this happens. And I also understand that when the US sneezes, the rest of the world gets sick. And therefore, if interest rates are going to increase in the States, then we'll probably also see this happen in my own country, like in Australia or New Zealand or the UK or Canada. We have besties from all over the world. And so what happens in the state kind of has a flow-on effect on the rest of the world. That's why we're so heavily focused on US news, because what happens there first kind of flows on, as opposed to like not caring about what's happening in the UK or not caring about what's happening in Australia and New Zealand. And so if you are sitting here and going, what do I do? There's just like a couple of things that I have in mind that will help you be better prepared. Because if you have a plan, you're not going to freak out. And if you have a plan, then when the markets do move around and things feel a lot more volatile, you're going to be in so much of a better position because you're like, oh no, I knew this was going to happen. Oh no, Sim kind of told me that this may happen. And so I'm not too worried. The first thing to note is that if in, I think it's the 17th of June, the Fed increases interest rates, then yes, we will start to see more volatility in the share market and shares might possibly drop, especially shares that are high growth. So think AI, think tech. And if you think of those two industries, you go, well, Sim, that's like most of what's moving the market right now. So that might have a big effect because the Magnificent Seven are moving the majority of the share market and they are all, if not like 99% tech companies or AI companies. So yes, that is a little bit of a concern. But we're not going to react to that news. We're not going to sell down our shares. We're not going to do anything different. We're just going to ride out the wave because we are long-term investors. We are putting our money into the market for 5 years, 10 years, 20 years. And so what happens in 2026 for like 6 months isn't enough to change our investment strategy. So we're going to see the market possibly drop, but we're not going to change our investment style. we're not going to log into our investments and move things around, because studies show the more you log in, the more you freak out, the more you start to change things around, and it's just not the best way to go. And the next thing that we are going to do is we are going to have 3 to 6 months of our living expenses kept aside in cash, not on the share market, in cash, because it might get volatile. You might have a job loss, or you might have your mortgage rate increase, or you might have your rent increase. There can be more uncertainty during times like this, but if you have enough cash set aside, then it just removes so much weight off your shoulder, because you're like, I'm going to be okay. I don't really need to worry. I can pay my bills for the next 3 months and then figure out my next steps. And so not freaking out with the market and keeping some cash aside and not logging into your investment portfolio are the 3 things that you can do. And if you're one of those people that still have a little bit of extra cash set aside, or you're in a position where you can invest more, then continuing to dollar cost average might actually be a really good thing, because if the market starts to dip, you're starting to buy shares on sale again. And how good of a feeling is that? Because recently, every time we buy shares every month for the last couple of months, we're just buying them at higher and higher and higher prices. And it feels good because the overall share market is increasing, but we're buying shares at a more expensive rate per share. And if there is more volatility and we're dollar cost averaging, we can start getting more bargains again. And so when the next rise happens, we're just like in a much better position. And so that's all I have for you today. I hope you've enjoyed this episode, and I hope that you end up subscribing to us on YouTube, or end up subscribing to us on Spotify or Apple Podcasts, wherever you get your podcasts. And I just have one little request. Please, if you found this helpful, take a screenshot, put it on your Instagram story, tag friends that invest. It helps the podcast out so much, and it helps us reach more women that want to become financially independent. And like, what better than a world full of women that have choices? And with that, I'll see you next week.